Cloud. All right. So I've got my spreadsheet here ready to go. So since the two of you are the first in the room, why don't you start off? Either of you or both of you have a question to start with?
I am just getting my bearings before I have a question.
All right.
Okay, I can start off real
Okay.
quick. So for the expected rate of return and calculating like the risk-free rate.
Right.
So like I know like that's like subject to change and we assume that like it's going to be higher in the future.
Right. Well,
We
what we want to do is not necessarily that it's going to be higher, just that we want to capture something that is going to be basically the average over the
okay.
next 10 to 20 years.
So we need like just one risk-free rate that's going to be like
Yeah.
not
Yep.
be perfect for all the years, but like be like in between.
Yes.
Okay.
Well, yeah, kind of an average, so it might be 5% one year and two the other, three another, somewhere in that 3.5% range. So what you're after is some sort of average.
Okay.
And traditionally, when rates were a little more stable in a normal environment, people would just simply use the T-bill. It's a little more difficult for us today. I mean, let's see, what's the T-bill at right now? Let's see. Yeah, 1 month T-bill is at about 5 3/8, which is pretty
Mhm.
high. I mean,
Yeah.
Yeah.
historically speaking. So what you want to do is to go back in time and look a little bit at what the T-bill would have been over the last 20 years. And, you can take a few shortcuts there. I would certainly look at what others are using for a T-bill rate. Bloomberg has a CAPM model in it. So actually,
Okay.
JJ, you could probably, if you plug that in and look at it, since rates are a little bit flaky this particular
Oh,
time,
okay.
it might be helpful to look at somebody else's. Let's see. I see 2 year notes are down at 5%. And if we go out to T bonds,
We're talking about T-bills, Braden.
yeah, yeah,
Sorry, I know this is off topic, but that means like it's like the yield curve is inverted.
yeah, right. Yeah, no, it's not off topic at all. I mean, that may or may not play into the picture of Steris and what they're doing with, where is their debt? That would certainly be an area I'd want to investigate. Again, I don't know if we've got time to go down that rabbit hole because it is pretty, you could go pretty deep on that. But yeah, no, that does, at least in that period. So like from 1 month to 2 years, yeah, it's definitely inverted. I was just looking for longer term rates. And let's see. And the 5 year is at 4.68, the 10 is at 4.65, and then the 30 is at 4.76. So it's a little bit inverted in the short term, and then it kind of flattens out a little bit in that 5 to 10 year realm, and then it starts upward sloping in the at 30 years. And even at that, if you look historically, these rates are above the long run historical average. So hopefully that helps. I don't want to. What I don't want to do is to say this is the answer, because that's not what this project is. So please don't misconstrue my somewhat vagueness. What I'm trying to do is to give you kind of the direction and let you all come up with some numbers.
And then like to go off that for the pro forma, would that impact like how they would like then like finance the like externally finance the rest of the company?
Yeah, absolutely. Yeah. So and now here's the trick though, right? And just remember that we're not consultants, we're simply analysts looking at what they actually are doing. And the question is will they actually do something different than what they already are? So certainly scratch that area, kind of get some sense, dig into it a little bit. Um, but again, each one of these spots is something that you could go down a rabbit hole for a lot of time. And I don't want to send you down, a pathway that is not necessarily going to pay off, in terms of the overall analysis, but be aware of it, be aware that that's an important element. That's the other reason too, that we do a sensitivity analysis, right? So we do, whatever rate you do come up with for the T-bill, whatever rate you come up with for the market risk premium, and then the beta, those three are estimated with some sort of error. So you could kind of do, okay, well, here's best case scenario, base case, worst case. And so you're going to have three different Ks, and you'll want to rerun all of your valuation models with those different Ks. And of course, interact it with the Gs. Actually, some of the nicer presentations that I've seen is if you make like a 3x3 table out of it. So put K on one axis and G on the other, and then you've got 9 cells. And you do that for your DCF, you do it for your dividend discount, and you do it for your price relative valuation. And then you've got this nice, 9 cells that go from, worst case in K, worst case in G, all the way to best case in K, best case in G, and everything in between. So that's a nice way to present that sort of stuff.
You mentioned that we could use the risk plugin for that on Excel.
At risk, yeah.
At risk.
If you've got time, yeah.
Is that something, if we would use that plugin, would that suffice for the sensitivity analysis? Would that help us do that portion of it?
Oh, absolutely.
Okay.
The only reason I say it's optional and if you have time is that there is a little bit of a learning curve in that thing. You essentially that instead of just doing like that 3x3 table that I was mentioning,
Okay.
it would be as though you did it on a, more or less 100 by 100, and what it's going to give you is a histogram, right?
Okay.
You're going to go into it and say, my K is normally distributed. You probably have to truncate it at some point, right? Even at that, and then maybe your G is uniformly distributed, and again, obviously uniform distributions by definition have an upper and a lower bound. And then you run the at-risk function through your spreadsheet, and it'll output a histogram to you.
Oh, okay.
But I'd only recommend that if you're pretty well ahead and you've got a couple of days of wiggle room before the deadline, and you want to play around with it. And you can download a trial version of that for free. So
Okay.
Dr. Elliott,
yes,
while
sir.
I was while I was calculating my market risk premium, I kept getting a very low number. And I was kind of attributing that due to how the markets were during COVID and all the volatility. Is there any way to get around that to get like a more like
Yeah,
better
I would.
number?
Yeah, I'd go back. Well, let me ask you this first. How far back did you go to get your market risk premium?
I was just doing 5 years.
That's where you. In fact, I'd say best practice would be to go back at least 20.
20 years? Okay.
And capture a full normal business cycle. I mean, I know we kind of went through a business cycle, but over COVID, that was that intended shutdown. But
Yeah.
I would go back at least to the early aughts. That should resolve some of that. Let me see. If we go to Yahoo finance. I'm going to just plug in the Spider ETF. And
what ticker are you looking up to get to the S&P? SPY, SPX?
Yeah, I was just using the Spider, the SPY. Here, let me share my screen with you. So yeah, it's the there's the ticker right there.
All right.
And that's the easiest one. I mean, there you can actually get the actual index, but I know we've bumped into some situations where you couldn't do the download. So just go over here. Let's see, where is the download for the, here we go. And I'm going back. Hang on a second.
So would you say like going back to almost 2000 would be good? Like maybe like post.com bubble?
Yeah. Yep. Yeah, so here, why is this not going all the way back for me? Hang on a second. I'm going to have to move you all. Here we go, Max. There it is. Yeah, I mean, out of Yahoo, we can get back to like 1994 quite easily. So what I would do is I'd go to the historical data. I would, yeah, I'm going to grab the max. And let's see. Download that.
And then I'd be looking for like the 10-year T-bill rate over the same period and subtract these
Yeah, you could do
returns from
that for
that.
sure. Yeah.
Okay.
Let me, I was just opening up Excel here.
Yeah, so just to ask off of that, so like you get how much has grown over the past like 20 years and then like divide it by 20.
Yeah. Well, when you're talking about the T-bill?
Like for the S&P to get
Oh, for
the
the S&P. That's what I was just doing here. Let's
give
see. I don't have, I'm not sharing the spreadsheet, am I?
no.
All right. Let me shift that around. Hang on. I can't see the bottom of my screen here. Let me do a new share. There we go. So what I would do here, come on. Why is this thing not cooperating with me? There we go. I'm going to cancel out the early 90s there. If we were to just go back straight to 2000, I probably should have done this on a monthly basis. In fact, yeah, I'll just deal with it as it is. We go to 2000, beginning of 2000, right here. And that's my adjusted price. So I'm going to take that one, and this will equal that value. No, sorry. And let's see, we're at row 17,250. Let's see, 1751 plus 252, 2003. All right, so I want to go to E 2003 minus E 1751. I made this overly complicated on myself. But there I've got my my return for 2000 is negative 11.4%. And then what I do is I would just copy that down and go out to 2001, and I get negative negative 9.5. Then scroll out to 2002, and I get, why am I getting negatives here on all of these? That I didn't think the market was down that much. Let's see, maybe I've got an error in there. There we go. Now we're back into positive territory, 22%, and so on. But you know what, I don't do what I did, which is I downloaded all the dailies, and I'm getting an annual just by going every 252 days, which is how many trading days there are in a year. Just download like the monthly, and it'll make your life a lot easier. And we can change the frequency here. Let me again shift my share to, I'm just going to share my desktop here, make it easier so that I would flip this to monthly frequency and apply it, and then it'll be a lot easier to get your numbers. Then you only have to go every 12 rows, and then average that. So right, once I'm there, what I'm going to do, once I've got all of these done, I'm just going to do some sort of average. Oops. For this entire row. And that would be my market return. Then I'm going to subtract off of that my market, my risk-free rate, that T-bill rate.
Would that be the average risk-free rate, or just,
Yep.
Okay,
Yep.
Perfect.
And I want to, obviously I want the next, 20 years after that as well in that average, but I'm just showing you, here it is on just like 3 or 4 years.
All right, perfect. Thank you.
Sure. So how about the beta calculation? Are you doing all right on that?
Yeah, I got the beta calculation. I did it with covariance and variance, like we discussed in class, and then
Okay.
I also ran a regression and got the same number.
Good. Yeah, the nice thing about running the regression is that you get your t-stats, your p-values, and your r-squareds. So look at those. You're looking for a very small p-value, meaning that it's highly significant, or a large t-stat. Those are directly related. And also you're looking for, ideally you've got some sort of r-squared that's double digits. Sometimes it gets a little flaky depending upon the number of observations and the particular security you're dealing with. But take a look at those too, just to give yourself some confidence. And then the last step would be, give it kind of the smell test, if you will. Does it make sense in the context of Steris, right? Steris is in a fairly, not quite a defensive play, but, less influenced by the market. So you would expect them to have slightly lower risk relative to the market. Now the leverage, though, can change that picture, right? So don't be too surprised, because they have a, as Dan was mentioning in his talk, a fairly healthy chunk of leverage at times.
Yeah. Also, I really liked how the fireside chat, like the format of the talk.
Oh, good.
Yeah, I really like that.
Thanks. That was it, and it was kind of fun. I enjoyed it as well, and hopefully you all got some questions. Yeah, I know everybody got some questions in, so that was good too.
I actually think that was better for his type of personality.
Yeah.
You could tell that he didn't want to stand up and steal the show for a few hours.
Right. Yeah, very interesting guy. It's nice to get to know each of these executives a little bit. I mean, even if for, maybe more in a formal sense, but,
Mhm.
you really get a sense of what they're dealing with,
Yeah.
and how they approach it and kind of the different cultures. And yeah, it's a neat experience. I'm glad that, and I'm glad that we get to have that smaller student session too. I think that's helpful.
I was joking around with Dr. Welke about how that one lady had said that she has two Steris tattoos in her family.
Yeah. Yeah, well, dedication. That was funny.
He was saying that that's a comment you wait to make until the end of the night.
Yeah, right. After the reception.
Yeah.
Yeah, we did not filter any of those questions.
So
Hey,
then
Doc.
we just take the K that we're using in the required rate section. We just take that and we put that in our DDM when we're doing the DDM.
Yeah.
Okay,
And in
so
fact, I apologize for the wording on the in the assignment and on the PDF. I say say for the DDM, I say calculate the required rate of return.
Yeah.
And actually just above that, I tell you to do that same thing. So I'm not suggesting it's different. I
Okay.
think I'll reword
Great.
that in the future.
Got it. And then whenever we are doing,
Oh, go ahead.
Oh, okay. So I'm working on the DDM.
Uh-huh.
And is it okay to simply add their dividends from the past year, add 4 dividends up, get one number, and that's D0?
Yep.
Okay.
That's the best way to do it. Yes,
And
absolutely.
then for, let's see, okay, that's fine then. I'll do that.
Yeah, you always want to go with the annual dividend.
Okay.
And then grow that, of course, right, to get your D1.
Yeah, would you recommend using a 5-year, 3-year, or 1-year growth rate for the dividend growth rate?
I would just do it for D1. I would just grow it 1 year.
Okay.
Unless I'm not understanding your question exactly.
So I thought we were going to build the DDM and we were going to have for the next 5 years. So like 1, 2, 3, 4, 5. I'm envisioning that D1 over 1 plus K plus D2 over 1 plus K squared. That's what I was envisioning.
You could do that. You don't have to. Now, the where you're doing the 5-year projection out with your pro forma, the result of all of that effort is going to turn into a free cash flow to equity. Now,
Okay.
you're right in that you could calculate the dividend out that way as well, but we're really kind of looking at, so I picture it this way. You've got what I would call the back of the envelope fundamental valuation technique. And in our case, we're using DDM. And you could use one of a couple of models. You could use just the constant perpetual growth, which is a single growth rate projected out from now to forever. And there you need just the D1. You could use a 2-stage model, which is in many cases kind of the optimal, where you have some sort of growth period between now and the next year to 5 years, and then you have another growth rate from 5 years out to infinity. And then the third model you might use would be that H model, where it still is a 2-stage, but you're scaling in between. So you've got the 1-stage growth rate from time 0 up to whatever time, and then the second stage out here. But instead of doing a step change, it kind of scales it up. And then the second method, again, also a back of the envelope method, would be the relative valuation. And that's typically using PE. You could use price to cash flow. That's not that's actually a better measure, from strict finance perspective, but most people use PE. And then the third technique is where you're going to use that pro forma and the 5 years, get your free cash flow to equity, get your terminal value, discount that whole works back at K, and divide that. That's your aggregate equity. And then you're going to divide that by your number of shares outstanding.
Okay, so it would be okay to just use a perpetual growth model.
Yeah, as long as you think that's reasonable.
Okay.
You know, if you have a double-digit G, definitely I wouldn't use the perpetual. I would do a two-stage,
Okay.
because you can't. The thing is that even a 10% growth rate projected to infinity makes the company just huge, right? So it's going to overestimate the value. And so be careful about that. If you've got a G that's single digits, in the mid single digits, then you certainly can use the constant perpetual growth. If you have a growth rate for the next 1 to 5 years that's higher, then I would recommend a two-stage. Or when we were just coming out of COVID, or when we were in COVID, when we were doing this, we had some companies where the growth rate was really low until we came out of COVID, or at least that was our projection, and then it'd go back up. And there again, you'd use the two-stage.
Okay. And is it the same G that we calculated before, or is it a G for the dividend?
Well, theoretically, the G for the revenue, cash flow, and dividend are going to be different.
Yeah.
But I'm really after, this is where I'll, make an exception, because we're at the 100-piece puzzle, not the 1,000-piece. Excuse me. And as a result, they have to converge. You can't have a revenue growth rate that's lower than the profitability growth rate, the earnings growth rate forever. Otherwise, you don't have enough revenue to support that earnings growth rate. So we're just going to use the 1G that you calculate.
Okay.
And we're going to apply it to dividends. We're going to apply it to the earnings when you do your PE, and we're going to apply it to the cash flows when you do your DCF.
Okay, great. Thank you.
Sure.
Going off the dividend discount model that he was just asking about, we were trying to work through it yesterday, and like we were using, the market cap divided by the public or the shares outstanding.
Okay.
To get
Market cap divided by shares outstanding. Okay.
to get the market price, and it seemed like we were like $1 off from the share price as it closed yesterday. But like when we use the free float, like all the public shares outstanding, it seemed like we got a closer one. Should we still use the shares outstanding, or do you know what we're like?
Yeah, no, it should. I mean, it depends on when they calculated market cap, probably, is what you're finding.
Do you think there's like a lag there between? Like,
yeah, pardon me. Yeah, it really depends upon, if you're looking at kind of a static set of ratios. And I don't know whether, were you looking on Bloomberg?
Yeah.
That should be dynamic, so it should be literally the number of shares outstanding, not diluted, the actual number of shares outstanding times the current share price.
Okay.
And what I don't know, though, is does Bloomberg update that market cap every second that the share price changes, every millisecond? I would guess maybe they don't. But yeah, no, that free float is really giving you a different measure. What the free float tells you, or the float, is that how many of those, if this is the number of shares outstanding, what proportion of them are actually available for sale. And so that's always something less than, because they're typically block holders and that sort of thing, where those shares will never come up for sale. So that gets subtracted out. That gives you more of a measure of liquidity of the stock. Yeah, I mean, I always like to take things to the extreme to kind of prove the point. If we only had 2 shares of float, and we still had the same demand for shares, that would, put those 2 shares in very high demand. So you'd have a lot of wild fluctuations in price. And but if you had, you know, the total number of shares outstanding, I don't know how many shares out do they have? 5 billion. No, it's not quite that high. It'd be what are they? About 20 billion market cap, and 100 and what are they at? 200 per share.
Yeah, around that, like 199.32.
Yeah. So divided by 200. Yeah, about a million. No, 10 million. 10 million shares, right? That doesn't sound right.
We were working with different numbers yesterday.
E to the ninth. Yeah, no, 100 million. Yeah, sorry, I was not doing the math right. So yeah, what you're finding though is probably an artifact of the way they calculated market cap,
Okay.
at the timing of when they calculated it, and then the price moves. So it may just look like that's closer, but they certainly wouldn't be using that to calculate market cap.
Yeah, that's
But
what.
what were you? So when you did that calculation, what were you after? That
Well, we needed it for what were we using? We were going through the dividend discount model,
mm-hmm.
and we were trying. I forget exactly what we were doing. I don't have it in front of me, but
Okay.
I just know that we were having trouble actually getting like an accurate measure, like the share price.
Mm-hmm.
And I don't know. I think it might be just maybe just lag, just maybe some data points. But if I had my project in front of me, I'd be able to tell you.
Sure,
But
sure.
I just got up 10 minutes ago. So,
I hear you.
but
I'm
thank you
only
so
about
much.
50 minutes ahead of you.
All right, I've got to go. Thank you, Dr. Elliott.
All
See you,
right.
Braden.
See you,
Bye-bye,
JJ.
Braden. How are the pro formas looking?
Pro forma might be one of the most challenging parts for me. I'm just trying to figure out where we are with it. Because we're
Do you
going
wanna-
through what's
Oh, go
that?
ahead. I was just going to say, do you want to share your screen?
Yeah, I can.
All right. Let me
Yeah.
give you access to that.
Because me and Braden were working on some other pieces. Jack was working mostly on the pro forma, so I was trying to get my
Mhm.
bearings of where we actually were.
I just made you a co-host, so you should be able to share.
Okay, let me get there.
Sorry for the background noise here.
Oh, no problem. Okay. Okay, let me get there. Okay, I'll start sharing now.
All right.
All right. So we started working with a G, and this is the balance sheet percent method, but it's just going through like we were trying to consolidate. Most of these have formulas in them.
Mm-hmm. Okay.
I keep running into this problem, not sure why. Because
That's weird.
we're sharing the workbook back and forth.
Right.
So usually I can only actually work on it in the terminal.
Okay.
But at least I could show you what's going on. I just probably won't be able to edit it.
Right. That's all right.
So we have percentages for the past 5 years.
Gotcha.
And then let's see where this ends.
And you did those, scroll back up just a couple rows to the total assets. Okay, great. Yeah, so you did that as a percent of sales. Good.
Yes.
All right.
I have a question real quick.
Yeah,
So
go ahead.
for the percent of sales, it's the percent of sales that year, right? So each year it goes a percent of sales like for the
Yeah.
corresponding. Okay.
Yep. Yep. Exactly.
And this should, yeah, that should equal.
Yeah, it looks like it does.
So it looks like Jack pretty much finished up this part. He took most of the work on the pro forma, and me and Braden have been splitting up among the calculations. But
Okay.
so this part looks like that might be done.
Yep.
And then
So now you're going out here, and here you're in the green are your projections. Let me take a
yes.
look. Let me have a peek at one of those cell formulas, say for
Okay, let's see if I can
2023.
do it.
No, yeah, it's fine. Just 07 and M9. Let's see, 07,
Yeah,
07.
sorry, it won't let me click in there.
Oh, 07 is your projected revenue. Okay, good. And M9 is your, okay, that's the 2-year average. All right. Yeah. Yeah,
And
that
we
looks,
were going to use the choose method.
yeah.
We have that for, I think we have that on the other one.
Okay. Yeah, I mean, you don't have to. I mean, I
Okay.
just put that up there as a possibility.
I thought that was cool.
That's why I put it up there too. I thought it was
Yeah.
cool. Said, hey, this is a neat little thing. I hadn't seen that function before. So now let's see. Let's go down to like your PPE, your fixed assets.
Okay.
I think it's right there, right? Yeah.
Yeah, it's 25, so it'd be this one.
Yeah. All right. So now that's the one. I mean, you can start off with it like you have it, which is as a percent of sales.
Okay.
But that's the one that you're going to want to change because you want it to reflect what you think Steris is going to be doing in the future. And as Dan was saying, they've been doing quite a bit of M&A, and if you look back, you'll want to go back to your actual dollar balance sheet instead of the one that is in as a percent of sales. So that tab on the far left there of your spreadsheet, and you'll want to look at what happened to the PPE there. So yeah, go back. Okay, great. So you've got row 26 there. PPE was steady for the 18 and 19, then went up for 20 by a couple hundred, went up again, and another jump up in 22, and then a little bit of a jump in 23. So, that for them, most of that has been the result of acquisitions.
Yeah,
And
and
so,
the highest is the most recent.
yeah. And that's not unusual for a company that's growing like Steris is. So
Okay.
you would expect some growth in the future. So the example that I gave in class of, a company that has a factory, and if they're at 50%, the sales can go up by quite a lot. They can double, right? Before you actually have to increase your plant property and equipment. So you could have, 5 years of growth at nearly 20%. Actually, it'd be a little bit less than that because it's compounding, right? But you could easily have 5 years of growth at 10% before you need to increase PPE. Now, Steris, though, is not that simplified version of my example, right? My example is just grossly oversimplified. Steris, they're actually part of their growth not only in revenue, but in PPE is related to acquisitions. So they're kind of buying factories, and they may or may not be at full capacity. We're not going to go quite down real deep into that rabbit hole. But what I would suggest is to use what you see here over the previous, you've got 6 years there.
Yeah.
Use what you see there, and then say, pardon me, and then go off of that and say, well, what does management say they're going to do in the future? And I think the answer we know from Dan's talk is they're going to continue to be acquisitive.
Yeah.
And so then you can project out some sort of just ballpark estimate of how that's going to be reflected in the PPE. Now,
Okay.
part of the reason I asked you all to go out and find current news on Steris, and now mind you, I purposely don't do a lot of research on the company yet. I kind of wait till right before the final deliverable is due, so that
Okay.
I don't influence you. But part of why you're looking at those current news stories is maybe there's some information in there about potential targets that Steris might buy in the next year or two.
Okay.
And that's why you're also looking at the 10K. Do they have any sort of acquisition, in their sights right now? And if so, you certainly want to factor that in. If it's a big one, definitely. If you don't see anything, then basically we're more at the very much a guessing stage and say, well, they've been acquisitive. They seem to be continuing to grow that direction. Let's assume for the next 5 years, they're going to follow what they've done for the past 6 years.
Understood.
One thing I should note here too is that, and the row 8 brought this to mind, is that they don't have the typical 12/31 fiscal year end. They have a March 31 fiscal year end. So your projections, when I was talking about using 2023 as a projected year, and I apologize for not recognizing this when I was talking in the class, but I'm really talking about the first projected year would be what you have labeled as fiscal year. Let's see,
I think that's
2020.
we have 2023 twice, which shouldn't be.
Yeah, right.
But
Yep.
on this one, let's see, is this correct? 23, 24, 25.
Well, what I would want you to do is to actually start with the year end of 3/31/24. That's your first projected year, right? Because the first half of that, what are we 4 months away from that? So the first 9 months or the first 8 months of that we already have in the can, right? So you know what that is, and so you're just projecting that additional 4 months on top of it.
Okay.
Does that make sense?
So we're going to have 24, 25, 26, 27, 28.
Yeah.
Okay.
Now, and here's another weird nuance here with companies that have different fiscal year ends than December 31, and that is usually they will reference the fiscal year as the year where most of the months occur. So, and I don't know if this is how Steris does this. This doesn't really matter for your project, but the way you have it labeled here is correct in row 3. But what I would change is what you have in row 4, which is that fiscal year 2023 ends at 3/31/2024.
Oh, okay. So we do have the correct format, but the ending is incorrect.
Yeah.
Got it. So we won't
That's
actually
usually that's typically the way companies refer to it. If they have a non-December 31 fiscal year end, they usually refer to that fiscal year as the year where most of the months occur. Because there are some companies that have actually a June 30 fiscal year, and then some that also are in September. So, but those are even more.
That's odd.
It is. I don't know how they select that. By and large, most companies are 12/31. That's why I hadn't even looked at this part of it. So that's kind of a small point. But
So we're simply keeping everything how it is, but changing the ending dates 24, 25, 26, 27, 28.
And correct. And make sure that when you look at your numbers, that those are, particularly balance sheet stuff, your jumping off point, the known point is going to be fiscal year 2022, which has a ending date of
23.
3/31/23. Right.
Got it.
Right. Yeah.
Okay, so I have a question.
Yeah,
So
go ahead.
for the growth rate, so that applies to everything on the income statement.
Yes.
And
Yeah,
then
for your
it's gonna-
projected years.
Mhm. And then
Correct.
it's gonna apply to, I know I watched the video and I wrote it down, but like current assets,
Right.
accounts payable.
Right. And that's it.
Okay. And then
Now, and so when I say that, at the end of the day, that's it. But if just in practice, if you just copy everything down through your balance sheet and do it as a growth rate, and as percent of sales, and then you can go like on JJ's the spreadsheet here that you've got up. You can go back and you can change that fixed asset piece, that PPE, to reflect what you really think it's going to be. And then on the other liabilities, the non-accounts payable, short-term debt and long-term debt predominantly, you're going to change those. And then you're going to change the equity pieces as well. Whatever is simplest for you in terms of mechanically doing this.
Okay. And then it's on the other things on the balance sheet besides the things I mentioned. That's when we do the choose function.
Now the reason I brought that choose function in was just to be able to give me some flexibility in terms of if the company was very different, during different years over my historical period. So say we've got that 5-year period historically we're looking at. And if I saw that the percentages were relatively the same on the income statement and the current assets and the accounts payable on the balance sheet, then I would just take the average. If I saw that the 5-year average, that is, if I saw that the more recent couple of years seemed to be different from the prior 3 years, then I'd use that 2-year, and maybe even something else changed in the most recent year. Let me throw out an example. Say they became much more efficient with their cost structure, and cost of goods sold as a percent of sales dropped drastically. Well, you're going to expect that to continue out into the future. So there, I'd want to use that choose choose part function that gives me just the most recent year. So that's more about providing me some flexibility to adjust the relationship between cost of goods sold and all the other sub accounts as you go down the income statement relative to revenue, depending upon a particular firm. So, in the case of Steris, JJ, would you mind going back to, let's see, the income statement as a percent of sales? Do you have that somewhere?
Yeah, I think we still need to work on this, but you could let us know how we're doing. Income
That's
statement.
that's
that's not
dollar
percentage yet.
figures. Yeah, not yet. Yeah.
Okay, so we still need to do that.
Well, I was going to use that as an example, but you would want to look at what's going on with Steris in particular, and then pick either, let's see, you've got the choose function in columns I, J, and K, right?
Yeah.
No, what is it? Is that right? Yeah.
I think we set it up, but I don't know if we actually inputted.
Yeah, you want everything in a percent when you do that for sure, but.
Yeah, I don't think we actually inputted the choose if function.
Oh, I see. You're just doing averages. Okay, gotcha.
So
Gotcha.
would that be fine?
No, you really want it as a percent of revenue.
Oh yeah, of course. But I mean,
Yeah.
would it be fine to just, so if we're not
Oh,
using
yeah,
the
yeah.
choose,
I see what you're saying. And then hard code it out
Yeah.
in columns L,
averages.
Q, R, S, T. Yeah. Yep.
Okay.
Yeah. Yeah, you don't have to use that choose function. It's just a little add-on that I thought was neat.
Got it.
Does that help, Johnny?
Yeah. So we just use the growth rate for the revenue, and then it'd be the percent of sales for the rest of it, and
Yeah.
just our discretion for whether to use the 5-2 or
Yeah.
choose it.
Correct. Yep.
Okay. Thank you.
Sure. Have either of you gotten down to calculating free cash flow? I don't think so, probably yet.
We
right?
haven't.
Okay.
Yeah. Because we're still working on the rest of this balance sheet.
Mm-hmm.
I believe we have, so the percentages are right, but then we have work to do over here. And well, because you said that some numbers were going to be percentages on this side, right?
No. Mm-mm.
Oh,
No,
okay. These will all be values.
Yeah. Yeah, your projections are going to be values. You want the historical in percentages just to kind of get a sense of what's going on a proportional basis, both on the balance sheet and on the income statement. And then
Okay.
you're going to project dollar values out.
Yeah, so we'll have to get these to equal. We have like 11,000.
Yeah.
Okay. That might
Yeah,
equal.
and so that's the next step, right? So if you'll
Okay, it does.
well, it does because you've got the balance sheet is all of it is as a percent of sales. When you start changing PPE and when you start changing long-term debt and your other your equity, and you start bringing retained earnings from the income statement over to the balance sheet at the end of the year, you're going to find that the balance sheet doesn't balance. So what you'll want to do in that case is you're going to have to decide what sort of capital structure do I foresee Steris having in the next 5 years. All right.
Okay.
And based upon that, you will then use your long-term debt and your additional paid-in capital as plug figures that will force the balance sheet to balance and provide you with the appropriate capital structure. In other words, the
Okay.
appropriate debt to asset ratio, right? And then let's see, what is that looking like now anyway? If you would go to columns LMN and then scroll down to the debt piece of it, I'd say total liabilities. Yeah, yeah, there you go. Thank you. So it looks like, wow, wait a minute, that is crazy huge.
Yeah, it is.
Like 106 is, you can't have that.
So it's probably not, well, I wonder if that's wrong or if that's just how it is.
Let's see. Let me look at that formula a second here. Oh. Okay, that's as a percent of sales. Yeah, never mind. No, that's
Yeah.
okay. That's okay.
That's okay.
What I was, sorry, brain fart. I was thinking of a normal common size balance sheet, which is as a percent of assets, but we're doing it as a percent of sales. I was going to use that to figure out what sort of capital structure the firm has, but I can't do it from here.
Oh, okay.
We could look at, let's see, that 4778 in that same row, and then what are the total assets? Scroll back up, 47,778 and 11. 47,778 and 11. Let's just call it 48.
And 11 too.
Would you scroll
Oh,
back
11
down to the
4.
total liabilities? Yeah,
What's
11
that?
4 for the. Would you scroll back down to the total liabilities?
Yep.
Okay, 4770. Okay, so 4778 divided by 11 4. I'm just going to round off. So right there, it's showing they've got about 42% debt, and so that means we've got 58% equity. And the job that you're going to do is to try to figure out, is that something that we want to continue out for the next 5 years? You notice, if I remember correctly, Dan did mention that they have some debt capacity, that when they do an acquisition, debt kind of ramps up, but then they immediately
Yeah.
get it back down with their cash flow. So you might look back historically and say, well, what has that ratio been? Has it been a constant 42%? Or are there some years when they do a big acquisition where it pops up and then back down? And I would, if let's say it's the latter case, then I would I would not use that one figure where it pops up because of a big acquisition. I would use kind of the longer run average.
Okay.
And again, also go to your 10K and try to learn, well, what do they expect to do? Do they think their leverage is too low? Also go to your DuPont analysis and look at the three pieces. We've got the profitability, we've got the efficiency, and we've got the leverage pieces. And look at those relative to the peer group, to the comparables. Kind of put all of that together, mush that together with, okay, this is, given what we've seen historically, given what the peers do, given what we've read in the 10K, here's our best guess as to what leverage is going to look like over the next 5 years. And there's a number. Now that number, and that once you've got that number, and you can actually, I'd recommend that you put it in as a like a cell input area on your spreadsheet, so that you can kind of go up to the top and always refer back to that number.
Okay.
So just when you're building the spreadsheet, just pick a number, any number, 40%, just, and then build your spreadsheet out, and then you can adjust that number as you've done all of the other work that I just mentioned, back checking the.
So that cell would be the percentage of debt that we would be
Correct.
changing. Okay.
Correct. Yeah, and I think I mentioned that in the video there. There's a little section where I say, put it up here.
Okay,
where
great.
You can adjust it. So that would be your next step on this. And once you've got, and you'll also, of course, need to bring your retained earnings over from the income statement
Right.
and add it to the retained earnings account on the balance sheet and the equities side. And once you've got that in there, and then make your PPE assumptions, then the next step is, the next kind of big thing is to get your free cash flow to equity.
Yeah.
And for that Wall Street Mojo page is where you want to look.
Okay.
But it looks like you're on the right track, doing a good job.
Okay, thank you.
Mm-hmm. Anything else?
What would be the next step with the income statement here? Just changing this all into a percent of sales.
Yeah, the historical ones change into percent of sales. Yep.
Okay.
And you could do that in a separate sheet, just like you did with the balance sheet.
And we don't actually need to project out for this original balance sheet, right?
It does, wherever you want to do it. What I and I think I did this in the video. I did everything off of the common size, the percent pieces.
Okay.
Just
well, I just mean, since we have this balance sheet, but we've already worked on this one, we don't need projections here.
No.
Okay.
Yeah, and I think it makes most sense because you're looking at the data as a percent of sales historically, and then you're projecting out, of course, in dollar terms. But this is the data that you're looking at because, hey, does this make sense? And then if you want to make any changes to it, that's why I did that choose function there. I could tweak it with that choose function.
Okay.
But yeah, I would do the projections off of the that percent of sales balance sheet and the income statement as well.
Okay.
All right. Thank you, Professor, for your time.
Oh, sure. You're welcome. Have a good rest of the weekend. Let me know if there are other questions that come up, and happy to answer via email, or we could set up another Zoom or a phone call.
Awesome. Thank you very much. Have a great
Sure,
weekend.
you're welcome. Thanks. Bye-bye.
Could I ask you one more, Dr. Elliott?
Oh, absolutely. Yeah.
So I'm looking at, okay, so we're on the right track for that one. I
Mhm.
understand DDM, we're doing G, so on the relative valuation.
Yep.
So we'll have the PE for we'll have the PE for the comparables.
Correct.
And would we also have the PE for Steris as well?
You could, obviously. I mean, you kind of want to look at what it is to make sure
Okay.
that when you're using those comps, that there isn't some gross mismatch between Steris and your comps. Yeah.
Okay.
But you would not include that in your average multiple that you're going to use, right?
Okay. And then so we use the average. Okay, so we have a PE for 4 firms, we take the average, and then that's what we use.
Yep.
Okay.
Yeah. Correct.
And then where do we plug in that number when we have that average?
Then you just take that average, and then you pull the most recent earnings from Steris, grow that to the next year, to 2024. Well, yeah. Actually, we're talking. It just kind of let's forget about the fiscal year ends in terms
Okay,
of this one.
2024.
So let's just think of that as the calendar year 2024. So you would grow the earnings that you currently have. Take the most recent 4 quarters.
Okay.
They just did They just did the earnings call Wednesday,
Yep.
right? So take that one plus the prior 3.
Okay.
Add those up, and that becomes your per share earnings for the year, and then grow that at your growth rate, whatever G you came up with.
Okay.
And remember, we're using that same G for earnings, for revenue, for dividends. And then that, so the most recent earnings times 1 plus the growth rate times your average of the multiples for the comparables.
Okay.
Does that make
Yep.
some sense?
It does. So average of PE times the most recent earnings times 1 plus G.
Yep. And those and make sure those most recent earnings are in an annual,
Okay.
and because they just came up with the quarter, the most recent quarter, right? So
Right.
and then let's see, that's going to give you price per share, so you don't even need to do anything else. That'll give it straight to you.
Okay, cool.
Yeah, the dividend discount and the PE relative valuation techniques are very straightforward and simple. All you need is your K and your G and your earnings and your dividend, of course.
Yeah.
And it's very, very much like what we did in the textbook. It's this pro forma and the DCF where we're really stepping way beyond the textbook.
Yeah. And whenever we're doing the next step says estimate growth rates for EPS and revenues, we're simply using G that we had.
Yes.
Okay.
Yeah. Again, to keep it relatively simple, in the short run, they can deviate from one another. In the long run, they have to converge. Plus, many of the things that are going to affect your revenue growth rate will certainly affect your earnings growth rate as well. So we may not have a completely accurate picture, in the relative valuation model. If we're using our revenue growth rate on our earnings, that may not be exactly perfect, but we know that we're measuring all of this stuff with error anyway.
Yeah.
And so as a result, that's why we have that base case, and then we do sensitivity analysis. Hopefully in that we've covered our bases in terms of the amount of error that we've, basically by using the same growth rate, we're introducing some additional error, right? You can think of it that way, but I don't think it's going to be significant.
Okay. And then whenever we compare that number to the market and industry would simply be the 4 comps, or if we find another measure that we're using.
Say that again. I'm not sure what I understood what you were
Yeah,
doing.
so we're on the relative valuation. We
Right.
did the PE. We compute the intrinsic value of the stock,
Right.
and then we take that and it says compare to market and industry.
Oh, yes. Okay. Yeah. Yeah. So you get, let's say the market price is, it's 200-ish. Actually, I've got it on my phone.
Yeah, it's at like 199.
Yeah. So the current is, as of, 199.32 is what it closed at. So you're going to get an estimate, and let's say it comes out to be 300.
An estimate based on our relative valuation.
Your intrinsic value estimate. Yep, the relative valuation estimate comes up to be 300. Compare that to the 199.32 and go, this seems like maybe it's undervaluation. Then do that sensitivity analysis, and you get, let's say you get 225 to 330. And you go, well, the current market price is still below our range even. And so that looks like true undervaluation. Let's say another sensitivity, let's say you do it with slightly different measures of error, and you come up with a range between 175 and 325. Then you go, well, the price is within that range, so we think it's fairly valued.
Okay.
Of course, if you came up with an estimate that was below the 200, you do the same thing. You're looking to see, is your estimate, is your intrinsic value less than, equal to, or greater than the actual market price.
Okay.
Yeah, that's all I'm asking there. And again, I probably should reword that.
Yeah, that's all right. And the way that we get that intrinsic value of the stock under relative valuation is taking that number we got from the average PE times earnings times 1 plus G, take that number times G.
No,
and that
don't
will,
even have to do that. Just stop right there.
oh, okay.
Yep.
So that we're gonna
average
have a
of all-
number,
Mhm.
and it'll be per share, right?
Yep.
So
Yep.
then times outstanding shares.
No, you don't even have to do that, because you can then you can compare intrinsic share price or intrinsic price per share against
okay.
market price per share. Yeah.
Cool.
And usually, when we're doing the DCF, you're getting an aggregate value out of that. The reason that we divide that by shares outstanding is that it's easier to talk about it relative to share price per share. People are just thinking in those terms. You could leave it as the aggregate value and compare that to market cap, right?
Okay.
Because those are then in the same units. But it's just more common. And out of the dividend discount model and out of the price relative valuation model, you're going to end up with the value in price per share.
Got it.
That's why we convert the DCF aggregate value back to price per share, just so all three of them now are comparable and we can talk in the same terms.
Okay. Yeah, I think that's good for now.
Okay. Very good.
Yeah, the
Well, if you have-
aggregate, we're
Oh,
converting
sorry.
it back to a price per share.
Yep. And as you go along, feel free, you can send me their spreadsheet and, pose a couple of questions as you're getting there. I'll be able to take a look at it, kind of check out your formulas and give you some feedback pretty quickly. So if you want to do things iteratively like that, I'm happy to take a peek. It may take me a couple hours to actually get to it and look at it, but I should be able to get back to you in fairly short order.
Well, thank you. This helped a lot.
Good. Thanks for coming and on a Saturday morning, and good luck with the rest of the project.
Thank you. Have a
Thanks,
great day.
JJ. You too. Bye-bye.